Today I'm going to share with you guys how to trade using Fibonacci retracements. Hey, welcome back YouTube. My name is Mike Swartz, and today I'm going to share with you guys how to use the Fibonacci retracement tool to trade. Now, normally during the live streams, I'll pull up Fibonacci levels and such. And if you guys would like to join me during my live streams, I stream live Monday through Thursday at 8:45 p.m. There's two simple ways you can get involved. The first, click the subscribe button down below and turn on the bell notifications. Or two, you can click the link in the description box down below and I'll send you an email notification half hour to an hour before I go live. All right, so today we're going to be using the TradingView platform. Now, TradingView is free. That's why I chose to do this video using TradingView. In my own personal trading, I actually use NinjaTrader for all of my chart analysis, but I wanted to use a platform that everybody can use. So if you want to start applying this concept today, it'll be very easy for you to do so. So let's go ahead and jump into the TradingView platform. Here we are in the TradingView platform. And again, if you want to log into TradingView, it's tradingview.com. I'm using the free version for this video. Again, I use NinjaTrader for my own chart analysis. But the first thing we want to do is we want to come over here and we want to grab the Fibonacci retracement tool. So I'm going to click over here, right here at the top, Fibonacci retracement. Now I'm going to left click. I'm going to drag it up to the right, just so we can see the levels that we're going to pay attention to. Now, if you've properly drawn the Fibonacci retracement in a bullish market, the 0 should be on top and the 1 should be on the bottom. In a bearish market, it would be reverse, meaning that 1 would be up top and 0 would be down here. And what I mean by that is, let me just draw a bearish one real quick. All right, it would be like this, right? Oops. You can see the 0 is down here and the 1 is right up here. All right, now I don't want to get you confused with that. Now, we need to come in here and change some of the settings real quick. So under settings, we want to go ahead and click off the 23.6 because that level, for the most part, is not really significant, at least in my opinion. I did add in the 127.2 and the 1.618. Those are external retracements. We'll probably talk about those in another video. Now, if you don't want the background to have these colors here, you can click the background off, or you can have the slider so it's dimmer or as bright as you want it. All right, that's all in your preference. Now, for today's video, I'm going to go ahead and I'm going to leave it on. I'm just going to dim it down quite a bit. All right. Now, the levels that we really want to pay attention to is the 38.2, the 50%, 61.8, 78.6, and the 100% level. Well, that just means the market came all the way back down to the starting point. All right. So now I'm going to go ahead and I'm going to remove this off my chart. We can just click right here and then the trash can button over here. Now, I'm going to bring the price chart back up and I'm going to start off looking at the SPX. This is the S&P 500. And then we'll go ahead and we'll take a look at, let's say, the euro dollar for the Forex traders. Now, one of the key levels I really like to trade off of is the 61.8. And the first thing that we want to do when we look for a Fibonacci retracement is we want to find the low part on the chart. All right, so right here, this is the lowest point of data that we have on this price chart. So at this point, I'm going to left click on my, I'm going to grab the Fibonacci retracement tool. Then I'm going to left click on my chart, all right, right here. I'm going to pull it up to this swing point here. And I'm just going to extend it to the right just so we can see. Now, when we zoom this up a little bit, we can, let's see if I can move price up. You can see that price came up. This is where we stopped our Fibonacci retracement tool. What does it do? It comes right down, spikes to 61.8 with a bullish hammer, and then what? The market goes up. Now, when we're looking to use the Fibonacci retracement tool, I don't want to simply place resting orders at, let's say, the 38%, the 50%, the 61.8. I want to look for other reasons to take a trade. This could be like we have a bullish hammer candle, and once we break above that candle, I can look to go long the market. In this case, that would have worked out fantastic. Now, I'm going to show you another example real quick. Let's see if I can fix that chart back. I'm going to get rid of this Fibonacci tool, and you'll see why I actually use price action to confirm the Fibonacci level. Now, what I did in this case is, From this swing low here, I grabbed the Fibonacci retracement tool, I pulled it up over to here, and then I just extended it to the right so I can see what happens as price comes down into our price points. And one of the things that we should be able to see is very relevant at this point is as we came down through the 38%, the 50%, 61.8, we had no signs of a bullish candle. This candle right here, still no signs of a bullish candle. 78.6, no signs of a bullish candle. We came all the way back down to where the move up started, and then we formed a bottoming, consolidation, and the market rallied back up. That's why I think when we're using the Fibonacci retracement tool, we need to use price action to confirm our levels. All right, now let's go ahead and look at current time. All right, now in this case, I'm going to measure from this last swing up. So the swing low right here up to the highest point on the chart here. And this is going to be relevant as of November 2nd. Now I'm going to show you guys one of the problems that we're going to run into with this analysis right now. I'm going to grab my Fibonacci tool from the swing low. I'm going to pull it all the way up here to swing high. Now here's the problem with doing this analysis right now. We have had no sign that the market wants to pull back, right? The market is not pulling back. So let's say tomorrow when I open up the price chart, price is up higher. At that point, I'm gonna have to take the Fibonacci tool and drag it up to whichever price has made the highest point. Now, as this market starts to pull back, the 38% retracement is gonna be the first area I'm looking for a bullish price candle. That could be a bullish engulfing candle, or it can be a hammer type of candle, right? A camera like we saw right here, or a real strong bullish green candle is what I would like to see. All right, that's looking at bullish Fibonacci retracements. Now we're going to come over and we're going to look at the euro dollar, and for this example, let's go ahead and use the bearish retracements. All right, so I'm going to start from this swing high right here. I'm going to grab the Fibonacci retracement tool. And when the market is trending down, we want to start from the swing high. And I'm just going to project right here to this swing low here, this first move down here. And we can see, look where the market has stopped. It stopped right at the 50% retracement, and then the market headed back down. Now, unfortunately, we didn't have a very significant bearish price action candle. We did have an inside day, and then the market came back down. Now what we can do is we can project all the way down lower, right? Now I can take from the swing high here all the way down to the low, and you can see the market was able to retrace all the way back up here. But let's look at the Fibonacci levels as the market is going up. All right, let's see if we can spot a potential bearish candle. Here's one right here. We have an inverted hammer. All right, it's like a hammer candle flipped upside down. Now the second criteria I look at before I look to place a trade would be, can price action break this candle's low? Well, the next candle does not trade lower than this candle right here. At least I don't believe it does, right? The low is 1.17936 versus, well, it actually tied it, so it did not break it, all right? So by having the sell stop 1 or 2 ticks below it, we would not have been filling that trade, and it would have saved us from a potential losing trade. However, where this candle was actually formed at would make sense to me, right at the 61.8. A lot of times we will get reaction at those price points. Now we're going to continue moving forward. We're going to see if we can find another place on the chart where this becomes significant. Well, we have this extended move down here. So now in this case, we're going to come back over, grab the Fibonacci retracement tool, swing high right here, all the way down to the swing low, and then I'm just going to project it over to the right. Well, look where the market has stopped. And in a strong trending market, a lot of times the market's going to stop at the 38% retracement. Well, what do? The market came down. We bounced up. Here's a bearish candle, but we never broke the low of it. Here's another bearish candle right here. The market came down a little bit and then spiked up a little bit higher and then ultimately came back down. So depending on where your stop placement was or your take profit, maybe this was a break-even trade, maybe this was a small winning trade, or maybe it was a losing trade. Again, this just gives us areas on the chart to look for possible signs that the market may want to stall out. This can also be very useful. For instance, let's say you went long right here in this green candle, and you're like, oh, I think the market's going to go up. This gives you a heads up to where might the market start to find resistance, all right? Fibonacci can be used as support and resistance. So at the 38% retracement, we want to look for, is the market looking weak up here? Is the market rejecting and starting to trade lower? If yes, then you might want to think about adjusting your stop loss or exiting the trade or whatever the case may be that fits your trading plan. All right, but this is a case where it says, hey, we could get a reaction. The market may want to take a little bit of a dip or at least consolidate at that price point. All right, here's another example on the euro dollar. This time it's going to be a bullish Fibonacci retracement. I'm going to start right here at this swing low before this move up. We have this consolidation here. So I'm going to grab my Fibonacci from the swing low. I'm going to project it up to this high, and then I'm just going to pull it over to the right. That way I can see the lines extended on the chart. Now keep in mind, in a strong bullish move, the 38% retracement, if the market stops there and starts to head higher, just know that we could be in a strong trend. This goes for bullish trades as well as bearish trades. This one just happens to be a bullish trade. As we come down to the Fibonacci retracement levels, we get, kind of the reverse of a hanging man candle right down here, because now we're in a downtrend, followed by a very bullish candle right here. This could be a point to enter the trade. Stop losses could be placed below the 38% retracement, and I would give it, a few ticks or so. And if possible, try to set up, a positive reward to risk ratio, regardless if that's a 1.5 to 1, a 2 to 1 reward to risk ratio, a 3 to 1, whatever the case may be. But if you were able to enter the market right here, a good target for this trade would be somewhere around this high. And if we're using multiple take profit zones, take profit zone 1 could be right around this swing high. The second one, we could just simply trail until the market, starts to falter. The market starts to consolidate, starts to break a swing low. Now, a swing low could be where this candle dipped right here. Stop loss could be moved to here. We come up, we set a higher low. The stop loss could be moved to here. Come up, again and again, until finally the market takes us out right over here, right? That could be a way to manage a secondary runner. But again, this all started from an entry off a 38% Fibonacci retracement level. Now, last but not least, I'm going to show you guys that this also works on stocks. And we're going to use Tesla to actually, convey this point. Now, everybody knows that Tesla is a rocket ship to the moon. And I'm actually going to show you a bearish trade setup on Tesla. All right, so here's what I'm going to do. I'm going to come over here, grab the Fibonacci retracement tool. I'm going to start from the swing high. Now, one of the things that we might notice is this first little move down, look where it came back up to and stopped, the 78.6. We had a little bit of a bearish candle, kind of not one that I'd want to take. We pop back up again, and then the market gives it back up. But I'm going to look at the overall move. I'm going to look at the swing high all the way down here to the swing low. All right, let's look right here at the 61.8, the golden mean it's called. Price comes right up here, and look what happens. The market actually reverses up and around this price point. Now the question is, do we have a potential entry? Now, every trader is going to be slightly different on when they look to enter and whatnot. I do not see any bearish engulfing type candles. I don't see any inverted hammer type of candles. So unfortunately for me, in my style of trading, I would not have had an entry here, even though it would have called it perfectly up to this retracement point right up around here. And if you actually look and you say, well, how do I know if I should take trades at the 38%, the 50%, the 61%? We want to look for bearish price action candles for a way to get involved. 38% retracement. We overshoot it a little bit. This candle hits the 50% retracement. And again, I'm still not seeing any bearish candles for me to personally get involved, right? Tesla came down and then rallied back up here. So for me, I would have missed this move back down on Tesla. But here's a very interesting thing. So even though we have the retracement from the swing high down here to the swing low, you guys may also pick up on this. Now, everybody knows that Tesla has been very, very bullish this year. It's at all-time highs as I'm recording this video. But now we have a swing low in place. We can pull up for this Fibonacci retracement right up here. All right, this would be a bullish retracement right up here. And then I project it right. I just want to see where the market stops right here. Look where it stops, the 61.8. We have a hammer candle right here, followed by a bullish engulfing candle. So I have two of my price candle patterns right here, and I have a potential trade setup knowing that I'm looking to target towards towards the high from where I pulled the Fibonacci retracement. And if I'm running multiple targets, I'm going to try to run a secondary target much higher. In this case, secondary target wouldn't have went much higher before the market actually came back. Hopefully now, after watching the Fibonacci retracement video, you guys can now see how powerful of a tool this can be, especially when you combine it with price action like bullish hammer candles, bullish engulfing candles. And, you know, if you have a certain candlestick pattern that you like, or price action pattern that you like to trade, Fibonacci can provide a great point on the chart, a point of interest, I call it, to see, is this pattern going to show up right here? If so, and it meets your requirements, it can provide some great trade locations in my own personal opinion. Like always, hope you guys enjoyed today's video. If you did, please give it a big thumbs up. I appreciate it. Till next time, good luck and good trading.